In the depths of human history, one metal has consistently stood alongside gold as the foundation of wealth and commerce, yet today it trades at a fraction of its inflation-adjusted highs, creating what might be the most asymmetric investment opportunity of our time. The story of silver is one of forgotten value, industrial necessity, and potential financial revolution. In the next few minutes, we'll uncover why this overlooked asset could be positioning itself for one of the most significant price movements in modern history. As we explore this opportunity, remember that all investment carries risk. This analysis is for educational purposes only. Let's begin with the numbers that have veteran investors paying close attention. The 1970s witnessed something extraordinary in the precious metals market. While gold produced exceptional returns of 1,400%, silver delivered an astounding 3,700% increase. This wasn't just a random occurrence, it was the market's response to conditions strikingly similar to what we're seeing today. Unsustainable government debt levels, currency debasement concerns, global economic instability, rising inflation fears.
Today's global debt situation has created a precarious balance. Central banks find themselves trapped between controlling inflation and preventing a debt crisis. This environment historically provides fertile ground for precious metals appreciation.
Unlike gold, silver plays two crucial roles in the global economy. First, it's a monetary metal with a 5,000-year history as money. Second, it's an irreplaceable industrial component in solar energy technology, electric vehicle manufacturing, medical applications, electronics, water purification, 5G infrastructure. This dual role creates a unique supply-demand dynamic. Industrial consumption provides a stable demand floor, while monetary demand offers significant upside potential during financial uncertainty. Let's address a crucial point: the hidden tax of inflation. Despite official numbers, the real impact of inflation on purchasing power has been devastating. Consider this sobering calculation: a $100,000 savings account from 2010 would need approximately $140,000 today just to maintain the same purchasing power. This isn't merely a statistic, it's a wealth erosion that affects everyone holding traditional currency. The silver market holds a fascinating characteristic: its relatively tiny size. The entire annual silver market value is smaller than single-day trading volumes of many tech stocks. This creates an intriguing dynamic where even modest increases in investment demand can lead to significant price movements. More revealing is the behavior of silver investors. Analysis of ETF holdings shows remarkable conviction. Investors tend to accumulate during price dips rather than panic sell, suggesting strong hands and long-term thinking. The relationship between gold and silver prices tells a compelling story. Historically, the gold-silver ratio averaged around 15:1 over centuries. Today, it stands near 81, suggesting silver is significantly undervalued relative to its monetary cousin. This disparity becomes more striking when we consider that silver is consumed in industrial processes, while nearly all the gold ever mined still exists in some form. One of the most reliable indicators for precious metals performance is real interest rates. When inflation exceeds nominal interest rates, creating negative real rates, precious metals typically thrive. Current monetary policy has created persistently negative real rates, establishing an environment historically conducive to precious metals appreciation. Let's explore the practical aspects of silver investment. There are several ways to gain exposure. 1. Physical silver. Coins and bars, direct ownership. No counterparty risk, requires secure storage. 2. ETFs and funds, easy to buy and sell. No storage concerns, potential counterparty risk. Lower premium over spot price. 3. Mining shares, operational leverage to silver price. Higher risk reward profile, company-specific risks, requires due diligence. 4. Futures and options, maximum leverage, complex instruments, requires expertise, not for beginners. As global debt levels reach historic highs and monetary experiments continue, the possibility of a financial system reset grows. Central banks worldwide are already exploring new monetary frameworks. In such a scenario, tangible assets like silver, which carry no counterparty risk and have intrinsic value, could see unprecedented demand.
The future of silver might extend beyond traditional investment and industrial use.
These technologies could combine the stability of physical silver with the convenience of digital transactions, potentially creating a new monetary paradigm. Success in silver investment requires a strategic approach. 1. Position sizing. Never invest more than you can afford to hold long-term. Consider silver as insurance first, speculation second. 2. Entry strategy. Dollar cost averaging reduces timing risk. Use price dips for accumulation. Monitor technical indicators for entry points. 3, exit strategy. To develop profit-taking levels in advance. And consider scaling out rather than selling all at once. Maintain core position for long-term monetary protection. The silver market presents a rare confluence of factors. Historical undervaluation, growing industrial demand, monetary uncertainty, limited supply, small market size. These elements combine to create what could be one of the most compelling investment opportunities of our time. The key is approaching this opportunity with patient accumulation, strong conviction, or risk management, long-term perspective. For deeper analysis and regular updates on the silver market, consider subscribing to our channel